Hello, good day. In this video, my group will be discussing about the various kinds of accounting concepts and principles that we use in practice. So, in accounting, we do not just record transactions. Actually, we are guided by different concepts and principles that we need to follow. So, first, we have that we call the GAAP or the generally accepted accounting principle. So, it is referred to a common set of accounting principles, standards, and procedures issued by the Financial Accounting Standards Board, or the FASB. Now, while in the Philippines, the GAAP is applied as the Philippine Financial Reporting Standards, or the PFRS, or the Philippine Accounting Standards, PAS. So these two are adapted from the IF, are adapted from the IFRS, which is the International Financial Reporting Standards, and IAS which is the International Accounting Standards. So, what are really they? So, this PFRS is to ensure. Sorry. So this PFRS and PAS are our guiding principles on how to record transaction. So the rationale for using the PFRS and PAS is to ensure consistency in recording, organizing, and measuring financial transaction, um, which, if followed properly, will ensure stability and transparency throughout the financial reporting process of the company. Oh, sorry. Now, to make it short, GAP are our guiding principles as accountants and how we are able to record transactions appropriately. It is also helps for, yes, consistency and uniformity in how we report transactions in accounting. Now, in this next slide, we will be discussing about the accounting concept. So the first concept is the economic entity, or the accounting entity principle or concept. So, the economic entity principle is an accounting principle that states that a business entity's finances should be kept separate from those of the owner, partners, shareholders, or related businesses. And also, as what I have browsed, according to the economic entity principle, all the financial transactions must be assigned to a specific business entity, and entities cannot mix their accounting records, bank accounts, assets, or liabilities. Again, it is to separate. Again, separate. And also, the economic entity principle is sometimes also referred to as the business entity concept or the economic entity assumption. It is considered one of the core fundamental principles of accounting. So, alright. So the next concept would be the actual basis of accounting. So as you can see, in accounting, we record the revenue when it is earned and the expenses when it happens, regardless of when the cash is received or paid. So I will state an example. Um, oh yeah, for example, if the revenue event happened in the month of January, then you receive your customers' money or payment by the month of February. It is still a transaction happened in January. Yeah, although you haven't received the cash yet, but you still need to record that on the month of January. So if you have expense same as expenses that happened by January and you get paid by February. Yeah, just like example, just like our electric bills, or you say our utility bills expenses, though we always use or receive it, but we only pay by the end of the month. So easy to say, accrual basis of accounting is a principle where revenue is recorded when earned, expenses are recorded when it happens, and regardless of when cash is received or paid. So I guess that would be all. So those are the two concepts and principles of accounting. So my group will be discussing the remaining discussion. Thank you.
Good day, everyone. Today I'm going to discuss the lesson 8, which is accounting concepts and principles. Some topics from this lesson will be discussed or with my groupmates, not other groupmates. So let's start. So the first one that I'm going to discuss is a going concern concept principle. So when we talk about going concern concept principle, the company will continue operating indefinitely into the foreseeable future, and the company future is infinite. So when we talk about when the business is a going concern, it assumes that the entity will continue to remain in business for the foreseeable future. If a business is not a going concern, it means that it's gone bankrupt and its assets will be liquidated. The second one is a monetary unit concept principle. So when we say monetary unit concept principle, transactions are expressed in monetary unit of measure. So monetary units state in accounting stated that you only record business transactions that can be expressed in a currency. So here in the Philippines, we applied a monetary unit assumption as PHP or Philippine peso. So this principle has two aspects, the quantifiability and stability of peso. So the quantifiability aspects means that we must record the assets, liabilities, capital, income, and expense in terms of the unit of measure, which is the peso in the Philippines. And if we talk about instability of the peso, so we assume that the purchasing power of the peso is stable and constant. Therefore, we may ignore its instability since it is not significant or it's not important anymore. So the third one, or the last one that I'm going to discuss about is the time period concept principle. So the time period concept principle, transactions are summarized and reported at regular time interval. So when we say time period concept principle in accounting, it's mainly stated that the business should report their financial statements appropriate to a specific time period. So when we say time period, so these time periods or these periods can be quarterly, half yearly, annually, or any other interval depending on the business and owner's preference. So we have two types of time frame interval, which is the calendar year, which is started at January 1 and ended with December 31. So we also have a fiscal year, in the starting point that's 12 months. So because there are also business who is not starting at January 1, so Yeah, I guess that's good, PR. Um, Thank you.
Hello, good day everyone. I am Rodeline Resor. I am the one who discuss about accounting principles. So, accounting principles have a seven types. So, I'm going to discuss the four types of it, and the following three types will be discussed with my co-group mates. So, what is accounting principles? So, accounting principles are the rules and guidelines that companies must follow when reporting financial data. So, their ultimate goal is to ensure that a company's financial statements are complete, consistent, and comparable. This is the first type of a accounting principle, which is the cost principle. Cost principle is an accounting principle that records assets at their respective cash amounts at the time the asset was purchased or acquired. So, when a business acquires an asset, the value of that asset is recorded in the business financial reports. So, this initial value is called the cost principle, and it is an important aspect of financial reporting for many companies. The cost principle is used to keep a record of a company's tangible assets without reflecting the market value. So that is all the cost principle. So let's continue with the second type of a accounting principle, which is the full disclosure principle. The full disclosure principle states that all information should be included in an entity's financial statements that would affect a reader's understanding of those statements. So, because the amount of information that can be presented is potentially huge, the interpretation of this principle is very judgmental. You know why? Because it is commonly to only disclose information regarding occurrences that are likely to have a major impact on the entity's financial status or financial results to decrease the quantity of disclosure. Matching principle. The matching principle is part of the generally accepted accounting principles based on the cause and effect relationship between spending and earning. So it requires that any business expenses incurred must be recorded in the same period as related revenues. So how the matching concept in accounting works. So the purpose of the matching principle is to maintain consistency across business income statements and balance sheets. So the first concept is that expenses are recorded on the income statement in the same period that related revenues are earned. The second will be the liabilities are recorded on the balance sheet at the end of the accounting period. And lastly, expenses not directly tied to revenues should be reported on the income statement in the same period as their use. So when expenses are recognized too early or late, it can be difficult to see where they result in revenue. This can potentially distort financial statements and give investors an unclear view of the overall financial position. For example, if you recognize an expense too early, it reduces net income. On the other hand, if you recognize in if you recognize it too late, this will raise net income. Revenue recognition principle. According to the revenue recognition principle, it must be recognized and recorded on the income statement when it's earned or realized. So business don't have to wait for the cash payment to be received to record the sales revenue.
So, good day everyone. I'm Arfaida Padam, and my presentation for today would be the continuation of the previous reporter, which talks about the accounting principle. So in her report, she talks about the cost principle, full disclosure principle, matching principle, and revenue recognition principle. For the continuation, let's talk about the materiality principle. So what is materiality principle? In accounting, materiality refers to the impact of an omission or misstatement of information in a company's financial statements on the user of those statements. If it is probable that users of the financial statement would have altered their action if the information had not been omitted or misstated, then the item is considered to be material. So, an item is considered to be material if it would affect or influence the decision of a reasonable individual reading the company's financial statements. This concept states that accountants must be sure to include and report all materials item in the financial statement. Next would be the conservatism principle. This is the concept that you should record expenses and liabilities as soon as possible, but to record revenues and assets only when you are sure that they will occur. If there are two acceptable alternatives in a situation, choose the alternative that will result in lesser income or resource. So in two situations where there are two acceptable solutions for reporting an item, the accountant should play it safe by choosing the less favorable outcome. Last but not the least would be the objectivity principle. The objectivity principle states that you should use only factual, verifiable data in the books. Never is a subjective measurement of values. And reporting process should be performed with independence which is free from bias. Accountants are expected to be objective and unbiased. Many businesses are required to have their financial statements audited to assure that us- the users that the amounts are objective and reliable. So that would be all for the accounting principle. Thank you.
Let's go on to the qualitative characteristics of useful financial information. So when we say qualitative characteristics of useful financial information, there are two components which is the fundamental and enhancing. When we say fundamental, the fundamental is the records of financial information. When we say enhancing is to enhance the financials. So let's tackle first the fundamental. So the fundamental has two branches, which is the relevance and the faithful representation. So when we say relevance, it is the effects of financials. Or when we say relevance, it is formally an item is relevant when has both predicted value and confirmatory value. So when we say predictive value, because of the item that they reported, we are able to predict what can happen to the future. So for example of this, the sales is rising 10% every year, so that we could adjust operation to be able to accommodate increase of sales of 10%. Then when we say confirmatory value, it is confirming the sales to the past. It is confirming what happened in the past. So that is the relevance. Let's go on to the faithful representation. So when we say faithful representation,
it is it is able to have faithfulness. When we say to have that faithfulness, we can accommodate the complete, neutral, free from error. So when we say complete, it has complete records. Then when we say neutral, neutral, not bias of the records. So for the neutral is you're not biased for recordings of financials, or you are recording not biased the sales in the past. So free from error is the trust and the trust of the owner that you are able to record what is the you are able to record the right things of everything. So that's all for the fundamental.
So hello guys, my name is Alehat Team and I'm going to discuss the qualitative characteristics of useful financial information, and it is enhancing qualitative characteristics. So it has four dimensions. And first is the comparability. So comparability is a comparable information enables the comparisons within the entity and across entities. Consistency, closely related to comparability, is the notion that consistency of accounting practices over time permits valid comparisons between different fields. Second is verifiability, helps to assure users that information represents faithfully what is purports to represent. Third is the timeliness, means providing information to decision makers in time to be capable of influencing their decisions. And last is the understandability. It is requires financial information to be understandable or comprehensible. So comparability is the degree to which accounting standards and policies are consistently applied from one period to another. Financial statements that are comparable with consistent accounting standards and policies applied throughout each accounting period enable users to draw insightful conclusions about trends and performance of the company over time. So, understandability is the degree to which information is easily understood in today's society. Corporate annual reports are in excess of 100 pages with significant qualitative information. Information that is understandable to the average user of financial statements is highly desirable. It is common for properly performing companies to use a lot of jargons and difficult phrasing in its annual report in an attempt to disguise the unperformance. So verifiability is the extent to which information is reproducible to the same data and assumptions. For example, if the company owns equipment worth $1,000 and sold an accountant the purchase cost, salvage value, the depreciation method, and useful life, the accountant should be able to reproduce the same result. And if they cannot, the information is considered not verifiable. So last is the timeliness, is on how quickly information is available to users of accounting information. Timeliness matters for accounting information because it's compete the other information. For example, if a company issues its financial statements a year after its accounting period, users of financial statements would find it difficult to determine how well the company is doing in the represent. So that could be all.